Happy New Year, everybody. Kirk Spano, and we are going to do a review and preview. So we're going to review 2023, and we are going to preview 2024 today, because that is what everybody is doing. You will notice in the top right-hand corner of your screen, unless you've moved it around live, but the recording should be my floating head at the top right of the screen. That is one of the things that will be new for 2024. I will be here staring right back at you. All right, let's start with the channel that I have set up here, Investing 2020s with Kirk Spano. I didn't realize this until I got a notice from somebody, or a note from somebody, that I've been on for a long time. And I only have a little over 2,000 subscribers. That makes me sad. I see some of the junk that's out there, and then I go through our videos and I'm like, wow, people would really be getting a lot for free if they just, subscribed. Now it's $1.99 a month, a whole $1.99. And I did that just to protect some of the real-time stock picks and option trades. So that, I think, keeps the integrity of the stock picks and investment picks and whatnot. So I went through the articles, and I'll tell you what, we got a lot right in the last year. My prediction for a round trip on the S&P 500 from an early correction to finishing the year strong was only half right. I got the number wrong for sure, but we did finish the year very strong, which is what I expected. So we're about 20% higher now than I thought we would be. And you would think that means that I'm forecasting a pullback next year. The reality is that while I do see a correction early in the year at some point because of the banking system and the commercial real estate, the reaction to that is going to be a lot of liquidity added to the markets because the Federal Reserve will create a special facility, don't call it quantitative easing, to bail out the banks. So when you get a chance, I would really suggest that you go through some of these videos. And while we are not 100% prescient here, I think we did a pretty good job. Spire Global, Palantir, Ametis. You go through the stock picks, I think they're pretty good. You can go through the articles at Fundamental Trends or at Margin of Safety. And I want to show you something. So for the year, the S&P 500 was up 23% and change. You know that I carry a lot of cash. And because I was cautious during parts of the year, you would expect I wouldn't beat the market. But you'd be wrong. Made 26.85%. And this is a screen share of where all of the gains came from. But where did I really make money on the cash? I sold a lot of options, right? Sold a lot of options. And I just kept on piling up premium. And what you'll see is that I just kept nickel and diming selling options over and over and over again. All those little gains added to the total return of the portfolio. In addition, we had some ETFs that did pretty well. ARK-F did well. ARK-W, I switched to at a later point in the year, did well. PBW, we actually are up a shade. TAN, we did pretty well by the end of the year. These aren't returns, these are contributions to the return. So of the 26-something% that I made last year, you'll see that each one of these contributed that much of the gain. Just like all of these options contributed a little bit over and over and over. So you can see, I sell a lot of options over and over and over again. And they did end up being pretty good for the total return. It doesn't give me an aggregate number, which is a shame. One of these was pretty big. I just saw a big number in there. Oh yeah, this was an Ametis call. So, made a pretty good gain there. Because remember, I did sell some of my calls and realized the gain. Different stocks contributed different amounts. Ametis has contributed a pretty big hunk of that. So about 1/5 of my total gain for the year was Ametis and Ametis option trading. When you go through, and Palantir did very well. Spire Global, people won't believe this, but we are net positive on that by quite a bit. Why? Because the first time I recommended it, which was way too high, we only bought a little bit. But then we loaded up back in September when I interviewed the CEO, because I was pretty sure that the stock was in good shape. Now, I was buying before I interviewed the CEO, and then I interviewed the CEO. Just like when we got into Ametis, I told you to buy the stock before I talked to the CEO. There's two reasons that I do that. The first reason is that I don't want to get caught with inside information. So I will take my position before I talk to the CEO. Now, if he says something that I hate, I can always sell my stock, right? But if he says something that is accidentally information that's not public, which happened, years ago, it happened to the CEO. He goes, "Oh, that's not public until next week." So I couldn't trade for about a week. So I take my positions before I interview a CEO now, and then I let the CEO validate my decision. So Palantir did really well for us. Spire Global did well, and a lot of these, they did well. AT&T was a detractor. SunPower has sucked. This was an earlier position in Spire. Took some tax losses for a few people. Satellogic, we dumped that one because I gave up on that one. And it might come back. It's cheaper now. So I'll have to revisit Satellogic. Haven't made any money on Planet Labs yet. Paramount, still down a little bit. And you go through all of these and you're like, now somebody mentions GBTC. And where would that be categorized? Oh, here. So I only have a couple of people who have GBTC, but it did do very well. Now, yesterday I was on a call with Teresa and I showed her my son's account because we were looking at Fidelity because there's a research report on Fidelity that you can find, ISS.EVA. And I'm going to mention it in my article on Ford this weekend. But ISS-EVA is a report that you can find on Fidelity Research that is very similar to new constructs. And I showed Teresa how much new constructs cost. It's almost $1,000 a month. The ISS-EVA, if you have a Fidelity account, is free. And it's really similar. It shows the real risk-adjusted valuation for a stock that considers both the return on capital and the risk profile. So it's a great score that they come up with, and I use it extensively. I've used new constructs, but when they raised the rate from $99 a month to $960 a month, I did say, it's good, but I can get it for free. Anyway, this is one of my son's largest holdings. Why? Because he's 28, 29, just turned 29 a couple of weeks ago. And I put a quarter of his money into GBTC, and I also was in Ametis for another quarter, and then half the portfolio was things like Palantir and some of these other stocks. She saw the return. Do you remember what it was, Teresa? Can you type it in? 150. And that wasn't 150. It was 106%. So my son's account returned 106% last year. And I guess technically it's still this year. And that is the power of concentrated investing, right? Now, had a couple of these investments gone down the tubes, could have lost 60, 70, 80%. So, there is a lot of power in concentrated investing, both to the negative side and the positive side. One thing that I'll mention here is that when you invest, people talk about diversification. We know statistically a couple things about diversification. If you buy the entire S&P 500, you are guaranteed to take 100% of the risk of the market. Does that make sense to you? It should, because if you own the entire market, you're taking the risk of the entire market. So your risk level is 100% of the equity risk in the large cap space, those 500 largest companies. So and really it's not even the 500 largest, because there's a handful of companies that aren't in there. They get added as they become profitable. The S&P 500 represents about 97% of the total market cap of the market. So for all intents and purposes, you're investing in the large cap space. The Russell 1000 is similar. It doesn't have as many restrictions, but it's 1,000 stocks, and that's 99% of the total market cap in the U.S. stock market. If you're taking 100% of the risk of the equity market and you're guaranteed to get the average return minus a small expense, is that really what you want to do? Do you want to take 100% of the risk with no opportunity to make more than the market? I've never ever subscribed to that. That's why I tell you over and over again, never ever buy SPY or VOOT. Those are terrible investments because you have no upside to the market and you're taking 100% of the risk. If we have a year where there's a 30 or 40 or 50% pullback, and we will another time in this decade, maybe twice, you're going to have a huge loss. And if you are not dollar cost averaging in, it's not even going to be average for you at that point. You're going to take a huge loss. And here's the other thing that I know is that usually people panic sell near the bottom. 80% in historical terms of people panic sell near the bottom. I think that's lower number now. I think it's more between 60 and 80, probably closer to 70, kind of right in the middle. There's a number of people over time as indexing became popular that don't panic sell as often. But you're still looking at, 60, 70 something percent of people panic sell. And that really just blows them up because they never get back in the market before it's past where they sold. They almost always buy higher. So they sell on a panic and then they don't buy until it's higher and they start getting FOMO. So they get emotional. From a risk reward standpoint, you should never want to take 100% of the risk of the stock market if you're not going to get a lot more upside. I held a lot of cash. So by holding a lot of cash, I'm taking a lot less risk in the market. And because I sold all these options, right, all these options where I only get assigned the equity if the stock price drops, right, a lower price point than today, I'm cutting my risk there. So there's other ways that Interactive Brokers measures, but it appears like my beta is about 0.8. So I have a little bit less volatility than the market, but my other statistical measures of risk reward are pretty good. They are crushing the market, risk adjusted return, and depending on which measure you like, it's by a lot. So if you can learn just a couple of things. One, diversifying across 500 companies is worthless because it doesn't cut your risk. What you want are ways to invest in a lower number of companies via your direct holdings and stocks and your ETFs so that your exposure is really only about half of that S&P 500. Why about half? It could be 40%, it could be 60%, but somewhere near half basically gets rid of the stinkers, right? Just think of a bell curve, and you want to have as little exposure to the crummy side of the bell curve as possible. There's not perfect ways to do it, but there are excellent ways to do it. And one of the things you can do is understand that appropriate diversification is somewhere between 200 and 300 companies if you want the optimal blend. And that's why I tell folks, look, if you put half or 3/4 of your money into ETFs and then the rest in stocks, 20 to 30 stocks, probably all that our brains can handle, you're going to have a pretty well diversified portfolio. And you've put a lot of work into the asset allocation so that you're on the correct side of the bell curve as often as possible. Again, you're not going to be perfect, but you can beat the market with less risk with very little effort. You just have to get rid of some of the biases of the people who are coming at you with information and not let it affect your thought process. The one thing that's out there for the millennials and the Gen Zers is this FIRE movement. I don't even know what it stands for anymore. Something about, freaking invest, retire early or something. It's a good strategy to invest, to just keep putting money in, to not overspend in your lifestyle, and to save money. Somebody put it up there, financially independent, retire early. Yeah, so the concepts are right from the standpoint of, look, don't overspend on the way you live. Now, some of these folks have miserable lives because they don't spend on anything. Well, hey, as John Maynard Keynes taught us, we all die someday. So since we're all dead in the end, I wouldn't advocate not enjoying your life, even at the risk of, spending some money that maybe that you shouldn't spend. If you save over time as you earn your wages and you're dollar cost averaging into investments, and you're making good choices along the way by picking out the right types of ETFs and not the SP 500 or through SPY or VOO, you're going to do really well. Focus on the things that do better, not the things that do worse. Don't say, oh, I'm just going to invest in the market because nobody beats the averages. Well, it's crap. I show almost every year that I beat the averages, and I do it with less risk. Even the years where I trail, I don't trail because I made a whole bunch of crummy investments. I mean, that's only happened like 3 years or 4 years. I think 4 years now. In 27 or 28 years, 1996 is when I started. I've had 4 years where I didn't beat the market. Four. And two of them had to do with oil crashing. So, over a very long period of time, you're going to have some years where you trail. But I didn't trail because I was doing things wrong. There were just events. And the next year I had huge up years. So, I mean, and that's even another lesson. Don't look year to year. Look at 2 to 5 year periods. That's really how long the cycles last. If you diversify properly, if you have good asset allocation, you're going to beat the markets. And this whole idea of using the S&P 500 is just a horrible thing. And I'm going to talk more about it over the year because I want to try to save those people, because when the next 30, 40, 50% crash comes, and it will, I don't want to see people get blown up. If you own better stuff, you'll do better. All right. I'm going to have to edit some of that down. I got long-winded there. My forecast last year was for the S&P 500 to finish the year around 4,000, having an early correction and then rebounding. Didn't really get a big correction, just a couple little minor pullbacks. 2023 was the year of buy the dip, buy the dip, buy the dip. Now, in the major markets after this, Shooter and I are going to talk about market structure a little bit more, but I want to go through just some of the things that I saw, because when I put out my report for the S&P 500, I said some of the things that I've seen in headlines, right? I think that we're going to continue to see lower inflation, and we've been on that since very early in the process, since 2022. I was telling you that inflation was transitory. It's just that the new price levels are going to be pretty permanent. Don't expect a lot of price levels to come back down. Energy is one that will be in a range. I talked about that on Forex Analytics. I said, look, the price of oil between $60 and $100 a barrel pretty much forever. I mean, could there be a spike outside of that for a hot minute? Could there be a dip below it for a hot minute? Sure. But really, the price of energy is going to be pretty stable for a pretty long time. Why? It's not in anybody's interest to have the price of oil be over 100. Why? Because if the price of oil is over 100, then the shift to alternatives is way faster. And the oil producers don't want that. They've made that abundantly clear. So we should see slightly higher energy prices in 2024, but it won't be much. And it'll really be driven by a dollar that's probably going to fall a little bit. And it's going to be weird because the dollar is going to fall a little bit, even though we have lower inflation, because the economy has really priced in a lot of the price increases already over the last couple of years and doesn't have to do it anymore. And even though higher energy prices would normally pull inflation higher. And one of the big boosts that I talk about, and you've heard me talk about it over and over and over again with the fourth industrial revolution, is that AI is really going to be a productivity booster. So the boost in productivity, which we really haven't had for the last decade, is really going to hit us hard now. So you're going to see all sorts of companies increasing their margins because as they apply AI, their employees can do more. Now, I don't think you're going to see layoffs. I know that everybody's afraid, oh, AI is going to take my job. No, it's not. It's going to make your job easier. You're going to get more done, and you're going to get more time off without having to have lower pay. Isn't that utopia? Your job's going to get easier. You're going to make as much money, and you're going to have more time off. I mean, that's everything that unions ever wanted. So, I'm a pretty true blue guy. And as you can see, the world just keeps getting better. So, as we deal with cognitive dissonance and we try to think about what's coming, I'll just tell you, even though I expect there to be a correction this year in 2024, it's going to be another buy the dip opportunity. So I think that as we get into January, you're going to see the January effect, because almost every year we get a January effect. That is new money coming into the market early in the year from retirement plans and people who took losses last year that want to get re-involved this year. You're going to see January probably be pretty strong, but at some point, and one of the things that I'm watching is the Federal Reserve meeting on January 31st and February 1st. I'm very cautious about that because I think we might get a chance to see mean Jerome Powell again, right? I talk about Jerome Powell being nice or Jerome Powell being mean, and he sets the tone for the narrative in the market, right? The market tries to front run the Fed, Sometimes it trails the Fed. Sometimes it gets surprised. Sometimes it anticipates well. You've got some analysts out there say, the Federal Reserve doesn't matter. I showed in my last article that's completely untrue. The Federal Reserve leads the market to where it wants it to go. And sometimes the Federal Reserve is a little too slow to act, sometimes a little too weak, sometimes too strong. They make mistakes. You know why? They're human. So when the AI takes over the Federal Reserve, everything will be perfect. No, that's probably not true, right? So the idea that the Federal Reserve doesn't have a major impact on markets is just fundamentally false. All the evidence suggests that. The thing that you have to remember is the long and variable lags, right? Sometimes the market doesn't react as strongly as it should or as fast as it should to what the Fed is doing. Sometimes it doesn't anticipate what the Fed is doing. Sometimes it doesn't understand what the Fed is doing. And I've explained over and over again that what the Fed is really trying to do is reload its bazooka for the next time that we have a crisis. Well, what we have coming in 2024 is a mini crisis. The commercial real estate market, as I showed in an article a week or two ago, is significant because commercial real estate is a rather significant part of the economy. However, it's not nearly as big as residential real estate. So even though commercial real estate is going to show the same sorts of defaults and drops in value that residential did during the financial crisis, it's 1/5 as big. So the Federal Reserve, with about $500 billion, can shore up the entire banking system to make up for the losses that are going to be blown in their balance sheets. Now, one of the things that also helps the Fed balance sheet is the fact that they can turn right back around and start doing more quantitative tightening if they choose to. I'm not sure that'll happen right away. It'll depend on if there's inflation, but the bank balance sheets, they benefit not only from a special facility, don't call it quantitative easing, but they also benefit from interest rates coming down. Why? It helps their loan book, but also it helps their investment book. Remember, banks invest in U.S. Treasuries. So if the interest rate on U.S. Treasuries falls on the short end, their bonds reflect a higher value. So there's going to be, on the low end, $1 trillion of commercial real estate defaults the next year or two. On the high end, about $1.5 trillion. The Fed's going to fill that hole with money. It's going to lower the Fed funds rate to around 3%. It'll probably happen sooner than later. I don't think you're going to see a glide path on interest rates coming down. I think when they start to lower interest rates, it'll be fast and it'll be hard. So expect that the narratives that are out there right now, what the market is pricing in, is mostly right on the standpoint of interest rate cuts, but the time frame and the amount and the purpose, probably all wrong. Doesn't matter. No, not really. If you are a good investor, then what you're doing is you're saying, okay, here's the 20 stocks I want to own. Here's the 6 ETFs that I'm primarily going to be in, and another 6 that I'll trade a little bit. And I'll just wait for the prices to tell me when to get in. And that's why that fourth part, what we'll talk about with Shooter in a little while, that fourth part of our analysis, right? Secular trends, be on the right side. Government and Federal Reserve policy, understand it so that you can adjust. If the government's giving a company money, that's probably good for that company. The fundamentals of the company, debt profile, return on capital, actual economic value, things like that. And then finally, the fourth step to investing is take a look at the technical indicators or quantitative indicators and the catalysts that are out there. If you just go step by step and you ignore most of the hot trader talk of the day, which is all just people talking their book, you're going to do very well. And you're not even going to have to put 30 hours a week into it. I'm probably managing money 30 hours a week and doing research another 30. 60-hour week, I enjoy the reading, so it's not that big of a deal. However, as you can hear in the background, the dogs are acting up. I think that if you can put in about 1 hour a day reading, hopefully you enjoy that. If you're managing your own money and you don't enjoy reading for an hour a day, probably shouldn't be managing your own money. I know a guy that could do it for you. I think if you put in an hour a day, you're probably going to do pretty well managing your own money. And you're going to be able to take days off too. You don't see me around very much on Saturdays other than this webinar, which I moved to Saturday so that I could go work out on Thursday. All right, what else? So AI is going to have a big impact. The New York Times put out some forecasting. It shows where all the big investment banks are saying the stock market will go next year. And what do we know? We know there's an institutional imperative. What is the institutional imperative? They just don't want to stand out. It means that if we say something that's about what the group is saying and we're wrong, we can say, well, everybody was wrong. But if we say something that is in the group, we just ignore that the group said it. And when it's right, we take credit. So if the stock market ends up at about 5,000 next year, RBS and Bank of America and Citigroup and Deutsche Bank and Goldman Sachs and, maybe Jeffries. Here, this is what these companies will say. They'll say, oh, look, we were right. They won't say everybody else said the same thing. Jeffries and UBS and Wells Fargo will all say, well, we said it'd be an up year. And we were a little bit cautious because, we have to be conservative with client money. JP Morgan will say, well, it's just going to happen later. So there's always a narrative that they can spin. The question is what do they actually return on your money? So, one thing to keep in mind, and I don't agree with this, but I think it's important to think about, is that I think we are going to get a soft landing, but maybe it doesn't give us the gains that I thought. Now, I actually don't think it's that relevant. I don't think the soft landing is what you should be focused on right now. I think you should be focused on the fact that there is commercial real estate issues that are going to create a special facility, don't call it QE, that's going to drive a lot of liquidity into the markets second or third quarter. So any dip between now and then, you really ought to be focused on buying. Now, in the next few weeks, as the January effect plays out, I'm probably going to do some trimming to raise a little bit of cash and selling some covered calls. Because I think as the market goes up and down, and we use our technical indicators, really the shortcut is relative strength index, or one of the substitutes, money flow index or shaken money flow. And then also the volume weighted studies that I put on the left side of my charts. You don't need to draw a whole bunch of lines. In fact, you'll notice that my charts, I don't put much on them. I don't annotate them much. I put a couple of low levels, like the bottom fishing, and then the area where, hey, I should start paying attention. It's either a breakout level or something that you start paying attention to because it goes under. It's a support resistance line that moves a lot. The bottom fishing doesn't move much at all because that's very fundamentally driven and driven by where the big money would start buying in. But if you can just basically use a few indicators, you don't have to go out there and draw a lot of lines. But one of the reasons that people draw a lot of lines on their charts is to say, hey, look what I'm doing. I'm doing smart stuff. Look, the system puts most of the stuff in there for you. So when we take a look at charts, Shooter annotates them because he's trying to explain what's going on. Most people just draw pretty pictures. It really is pretty simple. The more money that's going into something, especially if demand exceeds supply, Econ 101 stuff, if demand exceeds supply, and Teresa talks about this in all her trading articles, price goes up. If supply exceeds demand, price goes down. It's pretty easy. So if we take a look at the money going into an investment versus the share count and what's available from other investors, it's pretty easy to see why prices go up and down. It's just a function of supply and demand for the shares. And if we can measure that, which is pretty simple to do, you can get a pretty good idea when you should be buying and selling things. And if you overlay that with the fundamentals and say, hey, there's a stock up here that's worth this much, but I think in the future it'll be worth this much. I'm looking for the market to somehow get in this range so that I can buy it for the next leg up. Very wavy, right? So Shooter talks about that in the concept of Elliott wave theory. You don't have to think about it in Elliott wave theory. It's just a way to visualize. So these technical things that we do in step 4 are designed to cut your risk, because who wants to take 100% of the risk, and to give you a little bit more return. And if you can make an extra 3, 4, 5 points per year with less risk, why wouldn't you want to do that? So that's really what we're doing. Now, this year, again, read this article. It's also up under a different title at Fundamental Trends. I talk about what I'm really looking for. I think that we're going to get a euphoric market top in the next year to 2 years. And I think that one of the major catalysts will be the breathy, right? It's going to get very breathy on Bloomberg and CNBC and Fox Business of the commercial real estate crisis, which is a mini crisis. Remember, the Fed can throw $500 billion at it and it'll all be solved. They did that last year, and it didn't take as much money for the three banks that went under. And, this year is going to be more pressure. So when they throw the money at the market, everybody will be breathy and showing a lot of angst. Oh, it's the end of the world. Go get some green tea and say, look, I'm going to take a week or two off, and then I'm going to start buying. Fed is printing money. And what do we know? Regardless of what some other arrogant analyst says, the Fed matters. It's just a matter of where is the lag or the lead and how variable is it. Ultimately, we've seen the lines that show, and this is something that I really want to focus on, right? AI-driven earnings will surprise to the upside. That's one of the catalysts. Liquidity impacts investment sentiment. Liquidity speaks. Sentiment listens. Understand that. The people who don't understand that are just talking their book and selling their service. Here is the correlation. Liquidity and returns for the NASDAQ 100, and I'll show you the chart for the S&P 500 in a second, right? They don't match perfectly, but darn, that's pretty close, isn't it? Now, there was a divergence for the first time ever, a big divergence, even bigger than this one, and that's the AI hype cycle that I talk about elsewhere in the article. So here, how's that for liquidity matching up to the S&P 500? People who want to say that liquidity and Fed policy don't impact the stock market, they're ignorant and arrogant. And that's a dangerous combination. It makes them miss entire bear markets like in 2022. Yeah, they can brag about what they said, and then they can spin the history, but the reality is this, and that they didn't. All right, so the Fed is reloading this bazooka. It's almost done. It's going to use the bazooka. It's not going to fire at will. It's going to be very targeted. They're going to help the banks. Then the banks are going to pump money into the system. And you're going to see the economy kind of have maybe a first quarter lull, which we know is normal. And then it's going to come roaring out in the second or third quarter into the end of the year. And we're going to get a euphoric stock market during a period of low inflation, during a period when there's probably still some war going on in the Middle East and in Ukraine. And that's typically pretty supportive for an incumbent in office. So all these things are lining up to be supportive of the incumbent in office. Is that coincidence? I don't know, but it's happening. And we're probably going to see the market really take off at some point after it has a dip. So buy the dip. And that's really all I got to say about that. I'm going to go Forrest Gump on you there. Just buy the dip. All right. So let's finish up with, I think that the S&P 500 is going to make a run at 6,000. I don't think it quite gets there, but maybe it will. But my official prediction was this. How euphoric do I think it can get in 2024? I think the S&P 500 can reach 5720. That's just 160 in earnings times a 22 PE. That's all that is. That's how I came up with that number. Technical indicators say that it could make a run at 6,000. I don't think that happens until the first half of 2025, but who knows? $500 billion into the banking system is going to have a run-on effect. And with the economy at full employment and likely to stay at full employment for a very long time, why? Because the baby boomers are retiring every day for the next 7 or 8 years. There's a lot of people coming out of the workforce because they're retiring. And we're not allowing enough immigrants into the country, right? We let 500,000 immigrants in, and that's like, a few months worth of boomers retiring. So we need a lot more immigration. We're going to be slow to do it. But in the meantime, let's party like it's the 1920s. All right. I will take a couple questions if you have any. Let's see. What questions do you have? China's real estate is the possible next big one. I don't think so. Real estate problems are pretty easy to fix. You throw money at it. I mean, it really is a pretty easy to understand formula at this point. You throw money at these problems and they go away. And then you tear down some big buildings and you rebuild some new big buildings. It's just like in the United States, the solution to our commercial real estate is it's going to get converted into mixed use and residential. And that'll take a lot of pressure off the residential market. So we'll see. Did you know that the pending home sales in December was the lowest in like 8 years or something, or 9 years. It's been a long time. So you have a lot of real estate agents getting washed out of the business right now because they have nothing to sell. Hey, good time to get into real estate. What? Yeah. Get into industries that just got the crap kicked out of them because a lot of people left. Catch the next upcycle. The next upcycle in real estate will start in the next year or two because interest rates will be lower and people will still be employed. All right. Space stocks. Yeah, we covered space stocks. So I had Shooter do a primary waves on space stocks, the ones that I like. And I think that you are quite possibly going to see some doubles and triples in the next year. Do you see another opportunity to get into GBTC? Okay, so one of my biggest predictions, and that article's coming out tomorrow, is that I think Bitcoin. Remember, I did a webinar on Bitcoin where I said it would be 100,000 by 2026. When did I say that? In September? I think it's going to be in 2024. I think that we're going to get to 100,000 on Bitcoin in the next year or a year and a half, largely driven by liquidity and the advent of Bitcoin ETFs. So here's what I would say. We're going to have Bitcoin ETFs in the next couple of weeks. Just buy GBTC or buy BITO, which is the futures fund for Bitcoin. There's no more waiting to buy Bitcoin, Dan. Buy Bitcoin, buy Bitcoin, buy Bitcoin. Buy it, okay? We just had a huge block of money leave the exchanges in Bitcoin, which generally means it went into a wallet, which means they ain't trading it. They're just going to sit on it. That's what that means. So when money comes off the exchange in the form of Bitcoin, that means they have no intention of trading it. They're just gonna sit on it. And you have MicroStrategy sitting on it. You got Square that owns it, which they'll use to facilitate transactions at some point. That's going to be a big deal for Square. That's why we were loading up on Square in the last year. And that's one of our better stocks. So don't look for Bitcoin pullbacks anymore. Just get the heck into Bitcoin. I've been telling you for over a year now. If you had bought Bitcoin at the end of 2021, you would have made a fortune, right? So, yeah, Shooter says dollar cost average in, but do it fast. You got 2 weeks, man. There's going to be Bitcoin ETFs in January. They all met the end of the year filing deadline. All of them. There's like 8 of them. And then 2 funds that are converting. So GBTC is converting to an ETF, and their expense ratio is either 70 or 80 basis points. The expense ratios are all dropping. Fidelity is going to be the lowest one at 0.39, and they're waiving it until they get a half of a billion or 5 billion. I can't remember if it was 0.5 billion or 5 billion, but whatever. They're going to waive the fee for a little while. These Bitcoin ETFs are going to be as cheap as all the other ETFs, somewhere between 39 basis points and 80 basis points. And I think 1 or 2 of them are at 1%, which means they won't collect any assets. They're just trying to convert what they already have. They're not even trying to grow. So get into Bitcoin. Stop saying, I got to buy a dip. No, it's breaking out. It's not even up to its all-time high yet. It's going to get to its all-time high. It's going to jitterbug, and then it's going to shoot through. Just buy Bitcoin. Make 3 or 4 or 5 purchases over the next couple of weeks. If you get a dip, buy more after that. So figure out what you can put into Bitcoin, right? What's consistent with your asset allocation, and figure out a way to get in pretty quick. You've had over a year. I've been telling folks for over a year to buy Bitcoin. I understand the hear me now, believe me later thing, but Bitcoin's going to 6 figures. It's easy. It's easy math. It's going to 6 figures. And if you don't believe that Bitcoin is a thing yet, you're just being stubborn. Bitcoin is not only a thing, it is becoming a bigger thing because now they're competing with Ethereum. I think that you're going to see half a dozen major blockchains survive, maybe a dozen, but not many. And Bitcoin's going to be the biggest one by far. By far. Let me take a look at the Q&A section here. Latest thoughts on Sun Power. Same thoughts that I've always had. Solar is extremely volatile because we're still early in the solar economy. Again, it's going to take 10 or 20 more years to develop. But Sun Power has big oil money behind it. So if you're going to be in solar, have a big checkbook behind it because it's going to be volatile. I think that Sun Power is going to chop along here until Total comes out and says, hey, this is our kid. We're going to take care of it. And then Sun Power is going to go up. Would I be buying international and emerging markets? I love emerging markets long term. Again, hugely volatile. You can't just set it and forget it. So with the dollar likely to get a little stronger for a hot minute and then come down, you are looking to buy the dips on emerging markets too. And specifically, you want India on a dip. I mean, they've had a huge rally, so you need a little pullback there. But some of the other younger, tech savvy economies that have good manufacturing or have resources, Vietnam, Malaysia, Indonesia, you take a look at some of these places that they really have everything going for them. And one of the important things is a younger population, because that's cheaper for the government to finance, is really worthwhile. Theoretically, Africa is a big deal. There are a handful of pockets where you can invest there, especially through the technology. Companies that can drive earnings growth by being market leaders that get first mover advantage can do pretty well. I think that broadly speaking, Africa is problematic because it's just been so beat up for so long that it's going to be hugely volatile. And the leadership structures in a lot of countries are just not that good. The political systems aren't that good. They are vulnerable to massive shocks. So can you invest a lot of money in emerging markets and Africa? Not really, but you can, find spots for 6, 8, 10, 12% of your money, depending on how aggressive you are. And I think that you stand a chance to having huge gains, but you have to be willing to use the technical indicators to trade it just a little bit. Not a lot. When I say trade, I don't mean what Shooter means. Shooter's doing trades week to week. I'm more quarter to quarter, sometimes month to month, but really quarter to quarter, year to year. And that's really my time frame. Shooter says that a lot of emerging markets look to be bottoming. I really do like South America. I think that Brazil and now Argentina are going to lead South America. So there is a South America ETF, a Latin America ETF that I really like. It's listed with my 401k plan. And I think that that is probably a pretty easy one to be in. Some of the dividend generating stocks overseas, that the international dividend fund that I've showed you, I think that that's worthwhile. But again, I'm looking for total return, not specifically income or growth. I just want the most money at the end of the day. And growth usually is more important than dividends. So, we want income coming to us, but really it's the growth, the capital gains. If you have any ability to be a minimalistic trader, not a lot of trading, just minimalistic trading, you should do really well. All right, let's see. I don't see anything else in the Q&A. Les mentions EWZ. Yep, South Africa is on the list. I don't know that I'd buy specifically a South Africa fund unless you do some swing trading or just are really a little bit more active. If you're a fundamental trends rare investor, then the things that Shooter talks about with the country-specific funds probably up your alley. You can make a lot of money. I know Shooter, I believe, more than doubled his money last year. So while my kid had a double last year, really on the back of just buying and holding Bitcoin and a Metis, Shooter, scalped and traded his way there with his trading portfolio. So somebody asked, how does my year-to-date returns look based on different investing style? The growth accounts made a lot more money. Yeah, the growth accounts were closer to 40%. The dividend and option selling accounts were closer to 20%. So the growth accounts did really well, but the growth accounts are smaller. So on the weighted, right, the reason I only made about 26, everything altogether, was because I've got more money in the dividend accounts because, older folks have more money. All right, let me pause recording and we'll get Shooter all set up.